I'm Tim Kelly and welcome to this week's Video Insight. Well, after a long period of strong returns and low volatility from equity markets, last week saw an abrupt gear change, with global equity markets taking a step backwards and volatility suddenly spiking much higher. So far, the market disruption hasn't had much of an impact on overall valuations. As you can see on this chart, which plots the daily returns of the ASX 200 index over the past several weeks, we saw a significant one-off fall last Tuesday. However, while this was a big fall for a single day, the overall market decline from its peak so far is well under 10%. So if equities were expensive previously, so far not much has changed on that front. The big question, of course, is what might happen from here. There is certainly no shortage of experts willing to offer an opinion on what the recent moves signal and what markets might do in the months ahead. And today, I want to give you a perspective on how we're thinking about the recent market moves and trying to position for a good long-run outcome for our investors. The first point to make is that we don't have a clear view on what markets might do in the short term, and we doubt that anyone else does. At times like this, there are always some experts who say buy the dips and some who foresee doom. In hindsight, one group of them will look smart, but before the event, it's very hard to know which one. There are a couple of things we do know, however. One is that when equities are expensive, the long-run future returns tend to be less attractive. If you're buying a given set of future cash flows, the investment math says it's always better to buy those cash flows for a lower price than a higher price. So, in a world where equities have become expensive, we think it makes sense to be cautious, and for that reason, we hold a significant cash weighting in our long-only funds. The other thing we can see from history is that, to some extent, volatility follows volatility. So when volatility rises, it's a signal that there may be interesting times ahead. Volatility can drive prices higher or lower, so it's not always a bad thing, but for investors who are concerned about risk as well as reward, it makes sense to be a little more cautious when volatility rises. So while short-term market moves are very difficult to forecast, we're comfortable holding a significant cash balance in the current market. In fact, we think that for investors who do hold cash at a time like this, market volatility may well be good news, as it may give rise to opportunities to buy good companies at attractive prices. This chart helps to explain why. It's another look at the ASX 200 index over the last several weeks, but this time it shows the variability of daily returns across all the stocks in the ASX 200. What it tells us is that on the days last week when the market fell sharply, variability also fell. What that means is that all stocks fell by a similar amount, and that is exactly what we expect when markets become nervous. Instead of buying and selling in a considered way, investors can become indiscriminate and look to sell everything at once. This means that very good businesses with strong long-term businesses can fall by as much as more speculative and fragile businesses. When this happens, investors who are not caught up in the market's emotional roller coaster can find opportunities to buy good businesses at good prices. To summarise, while we don't know where markets will go next, we're not at all concerned to see volatility rising. If anything, we're happy to see the market becoming less complacent. For disciplined, long-term investors, we think that low prices and a fearful market provide the conditions for good investment outcomes in the years ahead. That's all for this week. We'll be back with more next week, and in the meantime, you can follow us on Facebook and Twitter.